Would it not be great to reach that point where your investments make money when you go to bed, when you take a dose or a sleep or whatnot, and your money's just making more money? How great would that be? And then that's why we are starting to get into dividends. In this video, I'll be telling you what dividends are, how they work, what to look at when choosing dividend stocks, and just how they can work for you. You want your money to make money for you. You want that cash dollar, you know? Dividend investing is often known as income investing or passive income investment. So the great thing about dividends is you're investing in a company that also pays you other than the capital growth you can make on that investment. In short, a dividend is a payment that your shareholders receive from a company, whether it be from that the company has too much money and they don't know what to do with it and they can't invest all of it back into the company, or it's a way of saying thank you to the shareholders, and then the company that way keeps their shareholders happy. Most commonly comes in the form of a cash payment, and it's what the company sends out either quarterly, monthly, or in rare cases semi-annually to their shareholders that hold stocks. You do get companies that don't pay dividends, and those are normally your companies that are very high in the growth sector. Dividend companies historically have a way of making your portfolio much less volatile. So it's often you can see the trends where a company that pays out dividends really is a lot less volatile than a company that doesn't. The big thing about why this makes your portfolio a lot less volatile is normally when stock prices drop like crazy and a company isn't paying dividends, your average investor will freak out and you'd either pull out your money, or when it drops so much that you think you can buy again and it just goes up and down the whole time. But now the thing with dividend stocks is when your price drops 2 or 3% into the red, you might not feel as anxious as if it didn't pay out dividends, because you're still getting money out of that company even though it might be dropping down a bit. So that's why it's very often where dividend stocks might drop, but you won't see a lot of selling going on in that company, because a lot of investors feel that, hey, at least I'm still getting something out of it. And that gets me to the point of why I love dividend stocks is even if your share is in the red and it's doing bad, that company is still giving you money. In the same breath, if a company does really bad, like during this pandemic times now, a lot of companies have suspended their dividends. Now, that's the thing, dividends aren't for sure. So you need to make sure that the company you invest in is assured of keeping their dividends. Because dividends are one of the best ways for a small starting up investor who doesn't just have cash lying around or coming in to grow their portfolio without doing actually a lot, because you're using the company's money to grow your own money. Just grasp that. And that brings me to why dividend reinvesting is, honestly, guys, I've said this, the eighth wonder of the world is compound interest. And dividend reinvesting, what it means is instead of your broker paying your dividend out into cash to you, you can opt to select an option where your broker just puts it directly back into the stock. So you reinvest your dividends you get out. Now, you can either do it if your broker doesn't do automatic DRIP, which is dividend reinvestment plans. If they don't do that for you, just take the cash you receive and put it back into the company. It's the same thing. I know a lot of people prefer that, where if they pay out the dividends to you, then you can choose what companies to put that into. Now, I would say if you're a starting investor, you're going to be receiving a lot of small dividend pieces. So there's no point in you accumulating that and then putting it because you're going into another company, because you're going to wait a while. So rather just reinvest those small pieces of dividends, start growing your portfolio, and then one day you can manage that a lot better when you have large amounts of dividends paying into your portfolio. On that point of reinvesting your dividends, guys, if you look at this graph, this is a comparison of the S&P 500 when if you didn't reinvest your dividends, this is the trend line. But now look at this when you do reinvest your dividends. People love comparing dividend reinvesting to that snowball effect. So I mean, we all have seen Tom and Jerry roll down a snowball down a hill, and then as it rolls down, it gets bigger, bigger, and bigger. So, and that's how dividend reinvesting is so great. I mean, if you look at this, I did a calculation of investing $10,000 into Verizon, And this graph shows without reinvesting those dividends, and this graph shows with reinvesting dividends. Think about it. This is money that you would not have had if you didn't reinvest your dividends, and you didn't use your own money to reinvest to get that value. This is money that came from the company. It didn't come from your own pocket initially. So dividend reinvesting, I can't stress this enough, guys, is mind-blowing. How do you choose one, and how do you determine if it's a good dividend stock or not? So what I normally do is, the first thing I always look at before I go look at the metrics or the financials of it is you need to look at this dividend stock that you're going to buy. Do they have a competitive advantage? Because it doesn't help you buying a mediocre stock and then have that large risk of the stock price plummeting to near zero, or them losing their dividend advantage because they're not making enough revenue to actually be sustainable with growing their dividends. And then secondly, understand the company. Like, I feel I'm going to say this in every video. You need to understand what the company does for you to invest in it. And then finally is, you need to go look at the history of these dividend payments of this company. Have they been consistently paying out dividends? You don't want a company that pays a dividend 1 year, suspends it for 3 years, then pays for 2 years again, then suspends it again. You want a company that's dedicated to their dividends. And also, important, you want a company that are constantly increasing their dividends, even if it's by 0.01%. From there, you're going to go look at the metrics. And then the first metric I definitely advise you to look at is the payout ratio. So the payout ratio says how much of a percentage do they pay out of their free cash flow or their earning. My danger spot is, I say I don't like buying dividend stocks when they have a payout ratio larger than 60. Definitely, I'm not buying a payout ratio larger than 80%. Because what that means is, let's say you get a company and their payout ratio is 90%. It's probably going to be great for you when you look at it because they're giving you some good dividends. But that surely isn't sustainable, because that means only 10% of their money is going back into the company to grow it and keep it sustainable. The most important metric you do want to look at is the dividend yield. So the dividend yield is normally given as a percentage, and what it means, it's literally what percentage would you get back if you invest into that company. So you're buying one share, and this is the share price. So of that share price, what percentage are you getting back? So how they calculate it is they take the annual dividend value of the last 4 quarters and they divide that by the stock price. So suppose you've got a stock price and it's $30 for a stock, and the dividend yield is 1%. So that means you're going to get every year. The dividend yield is often referred to as the forward dividend also. Also, it's not a big thing for me, but just make sure when your dividends are paid out. So when the company pays it out, is it annually? Is it quarterly? Is it semi-annually? So all that means is, if they say quarterly dividends, that means they're going to be paying out every quarter a dividend. So 4 times a year, they're going to be paying you a dividend. With your dividend yield, you definitely, whenever you see a company and they're paying more than 6% dividend yield, that you need to go look at why that company is doing it. So is it, for instance, a REIT, a real estate investment trust? So they normally have a very high dividend yield, or even a mining company might have a very high dividend yield. So, but let's say now you've got a company that isn't really growing, they don't have a large customer bases or whatnot, but they've got a dividend yield of like 10%, which is obviously not great, because that means they're going to be paying a lot of their earnings, they're going to be paying back to shareholders. And companies normally do this when they are in real trouble. So 2 indications to look out for, now this is not always, but it could show that a company is struggling, is when the payout ratio is above that 60% and when your dividend yield is above that 6% margin, because that means a company is trying to convince shareholders to give them money so that they can use that to try and save their company. Now, you need to know when to have stock in this company so that you receive a dividend. A dividend will be declared by a company, but now the important date you need to look out for is the ex-dividend date. And this you can find on Yahoo Finance or anywhere. You can go and Google an ex-dividend date of a company. And all this means is you need to have invested into this company before that date. Now, I like buying 2 days before ex-dividend, because depending on your broker, you need to be on record of having shares in that stock. So You can't buy on the ex-dividend date because you won't be reflected on their documents as a shareholder on that day. So you won't get dividends. So you have an ex-dividend date. Then from the ex-dividend date, you have your record date and you have your pay date. If you sell between that record date and the pay date, you will still get your dividend. So in summary, quickly, make sure the company you invest in has a competitive advantage. Make sure it's normally like a blue chip stock or it's got a good track record. Make sure the payout ratio is not above 60%. Make sure the dividend yield is actually achievable. And I like looking at 1% to anything to 6% for dividend yield, unless it's a REIT where you can go a bit higher, or if it's a mining company. Okay guys, so if you like this video, hit like, subscribe, drop a comment, and I'll see you in the next video. Thank you very much.